Hello and welcome to the Westpac Macro video. I'm Sean Callow, and joining me today in the studio, senior economist Matthew Hassan. Welcome, Matthew.
Hello.
Good to see you in the studio.
A novelty, yeah.
Yes, absolutely. So obviously a massive week for the RBA. We are still to hear from them at this point of recording from their parliamentary testimony and also the statement on monetary policy. But the big announcements we know from the statement and from the speech yesterday at the National Press Club, sponsored by Westpac. So we've got a lot of information, and so what are the key takeaways from you in terms of announcements and sort of anything else that stood out from the statement?
So, yeah, big week. This is the week where the RBA really sets the themes for the year. We're sort of still coming out of holiday mode up until now. And the message is very clear. On the policy front, they've extended the bond purchases by a further 6 months with another 100 billion in asset purchases. There's a firmer commitment to maintaining extraordinarily stimulatory monetary policy for an extended period, talking about unlikely to raise rates, the cash rate, before 2024 on the central case. No absolute hard and fast commitments, and they are reviewing some of the other aspects of QE, the term funding facility and the yield curve control down the track. But I think the message here is more about symbolism, because around the bond purchase program, they really didn't need to do anything until really March. They could have held off that.
Yes.
And we know that the outcomes around the virus locally, vaccine developments and so on have been better than expected. The economy's performed better than expected. So going into this, there could have been an option there for the RBA to sort of, not pass judgment, delay a little bit, but instead they've gone with a very clear message. And I think part of this is that we saw an explicit shift in approach from the bank last year. They promised this time around they would not be preemptive. They would be the opposite of preemptive. They're going to wait until they actually achieve their targets before moving on policy. And I think they're coming good on that view. The old RBA might have started mixing words and a balance of risks at this point, given where the economy is, given the strength of the reopening rebound we saw in the second half of last year, and some of these are the more promising developments around vaccines. But instead, they've doubled down on the easing. And I think it's partly because the game's changed a bit now. It's more about matching peers abroad, preventing the Aussie dollar from rising.
I was going to say that's something that really stood out from the FX point of view. Repeated mentions of the currency, and effectively, do you think their sort of hands were tied a little bit there? Because if they'd just stopped where they were, the Aussie dollar would have been very popular around the world.
I think they're super sensitive to that whole issue, and I think that's why they're going to piggyback on what's happening abroad if and when they decide to start moving on rates, because it's no longer just an Australian game. And really, when you look at the meaningful impacts of the latest round of easing, the quantitative measures in particular, yes, it's pumped liquidity in domestically and it's lowered funding costs, but it's not incrementally. It's not doing a lot more for sectors that are borrowing domestically. It's more around these channels around the currency.
They have the credit numbers. How would you characterise them? Not exactly booming, are they?
Not booming, but I think we've got a clear pickup happening. Around the new lending side of things. We saw a very strong number for housing finance. And we're back well above pre-COVID levels. And it's the new lending. That's the front of the wave when it comes to credit growth.
Maybe not business so much.
Businesses are still double.
There's
not really any signs of that really clicking together, and then you'd expect that to be slower to turn. But sort of stepping back, that's in place. The policy easing's clearly generating something. But where they're trying to maintain that stimulus is by preventing some of these the currency rising essentially.
And we were obviously expecting an upgrade in the growth views. Was it sort of roughly as expected? Would you say?
Broadly in line with expectations. So we did think that. So our view is that growth will be 4% this year. The RBA's gone for 3.5% this year and next. But their unemployment rate target, which is really the critical policy variable at the moment, they've got that coming back down to 6 rather than 6.5 by the end of this year, which is what we were expecting them to shift their forecast to. But I think
that's not low enough for wage inflation, right?
Well, it seems like we've got to go a lot lower. In some respects, we're still kind of dealing with some of the problems that we had even before COVID came along. So I think the part of the shift that's happened rhetorically is that they are aware that they weren't really meeting their targets, and then the shock happened. So they're going to have to really drive hard.
No, I think that's an important thing to re-emphasise, is that pre-COVID they were not on track for inflation or unemployment.
That's right.
They weren't good enough.
Yeah.
So it's one thing to get GDP back to where it was,
Yeah.
but you're still a long way off. And that is just seem to be pushing back pretty hard against the notion that they should be tapping the brakes.
That's right. That's right.
Okay. As well as obviously housing's always a hot topic in Australia or New Zealand seems to have similar sorts of numbers as well. It's only ever going to be part of the RBA's decision, obviously. But how do you see these latest really incredible numbers in terms of so it's not just approvals for construction, but it's finance for existing dwellings and prices overall. How are you characterising where we are now and where it might go in coming months?
So it's very clearly we've got a strengthening and broadening upturn in the housing sector. There's no two ways about it. We had a real trifecta of big numbers this week. I did add in the auction clearance rates. The first week, we're not quite back to reopened, but on reasonable flows around the auction market, we had 80% clearance rate in Melbourne, 75% in Sydney, in late January. Clearly big numbers. Price-wise, the Australia-wide measure is now 1% above its pre-COVID levels. It surpassed the previous peak in 2017. Housing finance and dwelling approvals are both up very strongly in the December month. Just be aware that some of that is relating to the federal government's home builder scheme. It's a scheme that gave $25,000 grants to eligible people who are building new homes. And that $25,000 grant will scale back to $15,000 beyond December 31. So there was a bit of a rush to get your applications in before then, and new home sales in the month jumped 100%. That's some idea of what that rush looks like. So that scheme, apparently there's been about 60,000 applications associated with that scheme.
Doesn't seem like a huge proportion of the total cost of construction, but it
goes a long way. I think it depends where you are. And what the other clear theme that's showing through is that this upturn is being led by the smaller capital cities and regional areas. So whereas the previous last 10 years, everything's been about Sydney, Melbourne, right? That whole cycle has dominated. The large high-rise construction cycle was really the thing we were watching most closely. This time around, the resurgence is coming through the likes of Brisbane, Adelaide, Perth, very strong activity in Perth, and also regional areas. And I think that adds a bit of a nuance. So firstly, those are areas where $25,000 goes a lot further on your build. The second point is that they were much less affected by the COVID disruptions locally. For most, it's business as usual. And very little impact. And they're also getting some indirect benefits. We've seen migration flows out of the big two cities into regional and second-tier cities in Australia over the last 9 months. And I think those things combined are really driving a big lift in activity and price growth. And it means it's a different cycle. Remember back, the high-rise building boom had really long lags on it. High-rise projects would take 3 or 5 years to completion. This is all about detached houses. It can switch on and off again very quickly in the space of 3 or 4 months in some cases. So I think there are still areas that are lagging. Clearly, Sydney, Melbourne, by definition. And within that, the unit segments are still look to be a bit of a problem area.
This is a very different composition, isn't it? If we've had a housing boom, aren't we normally, if we've got huge numbers, isn't it normally because their high-rises are being built?
Almost always. We haven't seen a detached housing boom like this.
It's a revenge of suburbia.
That's right. It's back to the 80s or something in Australia.
Spreading out.
So it's interesting, but I think that does caution a little bit because our view is that the rollout of vaccines is going to start to bring the pandemic to an end this year. And so some of these trends out of the cities, out of the CBDs, working from home, working remotely for the first time in 6 months, I think we've seen
that's right,
they will start to reverse a little bit once we get back to operating more normally. I'm not sure exactly what the timeline's going to be like that around that, but that does point to a bit of a caution about really driving this too hard. But for now, that's definitely the clear theme that's showing through.
So much to talk about. But just your very very last thing, just for today. Don't want to go too over time. But how would you get? What do you think the scale of the dwelling approval, the construction that we're also the pipeline of construction now? tells us about prices given what's happened to population growth, which was something that Governor Lowe is stressing about how incredibly low population growth will be this year or next.
It does sound a word of caution. It is one area we're concerned about, that if we go to this net migration outflow, I think we're expecting near term, it does drag the demand side down very significantly. So, on average, we might need to build 175,000 new dwellings to keep up with this population growth that we typically see. That could drop below 100,000 on a low, very weak migration flow. And it only takes a year or two where you've got building at these levels, very high levels, when you start to see substantial oversupply emerge. At the moment, we're actually in a position of undersupply, so we've kind of got a bit of breathing space there. But if the longer we delay normalisation on things like migration, the more we run the risk of having imbalances the other way, maybe in a year or two. I don't think it's an issue for this year, apart from maybe some pockets like the high rise in Sydney and Melbourne. But it is one area to keep a very close eye on policy-wise.
No, it's an important point to mention how we may have had the stronger than expected domestic economy. The recovery might be ahead of schedule, or previous forecasts, but the international environment is absolutely not. We're still not. Nobody's been bringing forward their expectations for opening borders, getting students back, tourism. So,
if anything, it's moving the other way.
Yeah, absolutely. Yeah. No, honestly, we would have thought. I asked us a few months ago that the Australia Kiwi New Zealand travel bubble might be fully operational by February.
Yeah,
it's not close. No, we will still be very optimistic for maybe the second half of the year. So, look, as I say, lots to cover there. Very much appreciate your time. Thanks for coming, Matthew.
You're welcome.
And thanks for watching, and we'll speak to you next week.